All right, let's get started with the first conversation for today. Now, since the precipitous fall in equity markets in March of last year, we've had a stupendous run. In fact, during that period, the Nifty 50 has risen from levels of 7,511 and it has gone past 18,000. But here's the thing, if you entered the stock market in that time, you haven't really faced defeat, disappointment and humongous loss. Of course, there are a few cases where stocks have corrected sharply. Take for instance the IRCTC share price in the recent past. But broadly, stocks have gained and they've gained handsomely. But just because you've made money so far, that doesn't make it a winning strategy for the rest of your life. And well, if you haven't started investing and you've missed the bus so far, you got to listen in very carefully to this conversation. The first chat is going to be about the right approach that you need to take to build a portfolio of stocks that will stand the test of time. And the man who's going to give you a little bit of the advice and wisdom that he has accumulated over the last 4 decades is Mr. P.V. Subramaniam, who's author and founder of subramani.com. Thank you so much, Subra, for taking the time. You know, a lot of people have made money over the last year and a half in the equity markets, but I think a lot of people also lose money. Why do you think that people lose money in the equity markets?
So, Alex, if you had invested in 1979 and held on till today, your portfolio would be worth some $90,000, right? 100 would have become 90,000, because that is the full. That is what the full TRI, total return index, has become. But not everybody makes that kind of money, right? You need patience. You need the ability to sit tight over long periods of time. You should not get scared. And you should, first of all, know the difference between trading and investing. So if you are a trader, you have certain things like stop loss. If you are an investor, you do something like averaging. People get in as a trader and then they make a loss because they are unable to sell at a particular price, pre-decided or whatever. And then they say, oh, I will average it. Now that, which means you are combining a trading strategy with an investing strategy, which means you're not clear whether you're a trader or an investor. That is step one, why people lose money in equity markets. Have the clarity. Why are you buying? What will you do? Will you hold it permanently? Will you hold it for 40 years, 30 years, whatever? Know something about the share that you're buying. And it's a business, right? So, and be very choosy. You don't have to buy one share every day. You have to buy one share every 6 months. That is the kind of time frame that you need. So if you are buying one every day, there is just not enough time to know what you're buying.
So there aren't really, I don't think that people have thought enough about this, Subra, and I think it's important, at least I think it's important to make that distinction right at the onset. Like you said, you need to understand what sort of stocks you're buying and for what period. I would think that yes, understanding whether you're a trader or an investor is first and foremost. What makes you an investor and what makes you a trader? Can you be both?
You can be both. There are a few people who are gifted, like say Rakesh Jhunjhunwala, who can wear on both hats. But there are very few people. Rakesh Jhunjhunwala is an exception. There are very many people who struggle between the two, and they're very clear that, okay, I'm going to be a long-term investor, and that is what I will do. So I don't need any skills to predict the market on a day-to-day basis or predict a share price on a day-to-day basis. So I know I will buy a good share. It's a good business. I will look at the promoters. I know what all to look for. I have a checklist, 1, 2, 3, 4, 5, and then I buy it and hold on for dear life. I may be holding it for 5 years, 10 years. But remember, Alex, it's very important. It is not, I don't take a 10-year view on the share. I buy it. And every 6 months, I take a decision not to sell. See, sometimes a decision not to sell is a decision to hold. That is taken every 6 months. I look at the results and say, wow, this is not bad. Wow, this is good. They're increasing market share. I keep reinforcing the belief that it's a good share and therefore I bought it. But suddenly halfway, if I feel that, oh, it's not so good, the father is a good man, the son is not a good man, so, things are changing, then I might sell. So there has to be this active passive investing. I'm little contradicting myself, saying you have to be active in the sense that you look at what is happening, but you will hold it passively for a period of 10 years. But passive holding for 10 years does not mean you don't look at what is happening. That's a big mistake. There is no fill it, fit it, forget it kind of a share. You can't buy an Asian Paints or a Pidilite and say, oh, next 10 years I need not worry. Today's prices don't give you that luxury. You have to buy, you have to be alert, you have to see what is happening. And if the returns are not good, I don't think the returns in Nestle in the last 1 year would have been more than 4 or 5%. That's not a great return, but the prices are already high. So what do you do in such cases? So good shares are not available cheap, and cheap shares which are available may not be good. So when you buy expensive shares, you have to be far more alert, because you can spend 5-7 years doing nothing in that share, and which means an opportunity loss.
Absolutely. I want to get into some of the aspects that you've spoken about because I think this will benefit a lot of people who are perhaps not taking the right approach and perhaps not investing yet in the stock market, but are keen to do so looking at the way stock markets have moved. But the first thing I will ask you is, if you are approaching portfolio construction, and here I mean if you are looking to have a few stocks that you own, what is the first thing that you need to do, and how many stocks is too many, Subra?
You don't need more than 30 stocks. There is a Bombay sensitivity, Bombay BSE Sensex, which tells you that the total number of stocks they have is 30. The Nifty has 50. You don't definitely need more than 30. And it also means that you have to have a balance. So the day you decide to create your own portfolio, look at the Sensex and see which are the industries that it represents. And in those industries, you need to pick one. So if you think HDFC Limited is good, very good, State Bank, HDFC, maybe a Sun Pharma, you just have those shares which are there in the index. That's a good way to say, this is how my own portfolio should look. There is to be a very, very strong reason for you to be overweight pharma or overweight entertainment or overweight BFSI. That is the way you construct a portfolio. These index is beautifully constructed. Just copy it. Don't need to do anything very different. You may not buy HDFC. You may decide to buy some other bank. That's fine. But you should know how much percentage should be banking, how much should be pharma, how much should be steel, how much should be oil, right? So that you don't have to do, don't use your brain, just copy the index.
Okay. Having said that, you just mentioned you need to have a high degree of conviction about the stocks that you invest in. How does one approach this? Do you look at the company, look at the business, try to understand what they do and only then put your money in? Or do you have a strategy where you choose these top sectors and you allocate maybe to the market leader in each?
Both are right, because see, what happens is, like, you have a full-time job. Will you be able to find time to do all that you said? Will you be able to do an analysis of Sun Pharma, of an Indian Oil, of a State Bank of India? Believe me, these balance sheets are huge. It takes a lot of time to read. And today there is so much on the notes of accounts that it's very difficult for ordinary people to read it. A typical accountant of the company spends 365 days with it. An analyst spends maybe 50 days with it. As an individual investor, you are expecting to understand all that in 3 days or 4 days. It's really very difficult, especially with a full-time job. So largely you go by what people are talking about it, and read some research reports and have the conviction that yes, this company will survive the next 10 years. 10 years later, people will still be washing their hair, taking a bath and brushing their teeth. I don't know whether Facebook will survive, but I know that P&G or a Colgate will survive, right? So find out, have your own conviction, buy it, see how it works for you. If it doesn't work for you, at some stage you may have to review it, you may have to get out. And believe me, for all this trouble, and you also compare yourself as to how you're doing compared to 3-4 fund managers or the index. If you're underperforming, have the humility to say, I cannot outperform, so let me go and put money in an index or with some fund manager, XYZ. I'm not naming anybody. But at least do a constant comparison of the actual versus the budgeted, and see whether you're doing well. If you're not doing well, have the humility. I mean, none of us play cricket like Sachin Tendulkar, right? So we still watch cricket. So what stops you from doing that?
Okay, Subra, we're slipping into a short break now, but I would like to speak about this a little bit more, and we will do so after this break. Viewers, do stay tuned. The next bit is going to be as interesting as the first. Welcome back to The Money Show. We've been talking about equity and how you, as a retail investor or a retail participant in the equity market, can approach the construction of a portfolio. My guest is P.V. Subramaniam, and he's already given incredible advice that I think will hold all of you in good stead. Subra, we were talking about the approach one should have when selecting companies. Now, a lot is said in terms of valuation of companies, the fact that they are expensive right now, and obviously a lot of novice investors sometimes make the mistake of looking at the price, the ticket price, and saying, oh, this is too expensive, but actually you're talking about the price to earnings ratio and various other aspects. Should a retail investor get into that level of detail in terms of making their own calculations?
Absolutely not, because of two, three things. One is there are too many gods now being promoted by social media. So there are people who swear that you buy Asian Paints at any price and it is good. You buy Pidilite at any price, it's good. You keep buying HUL and ITC, you will never lose money. This is not true. If you had bought Wipro in 2000, it would have taken till 2010 for you to get any semblance of the price back, because two, three things can happen. One, the PE could have been very high when you bought, and then every subsequent increase in the earning is offset by a fall in the PE. So you could take 10 years and not earn any money. You might lose patience. Same thing has happened over the last 3-4 years with ITC. It happened even in case of Reliance for 5-6 years, it didn't earn any money. So the question is, do you understand at which part of the cycle the company is, what is happening to fuel prices? And, if fuel prices are changing, Asian Paints benefits. If fuel prices fall, Asian Paints benefits. Now, if fuel prices are going up, maybe it's time you have to rethink as to whether Asian Paints will be able to pass on the price hike always, continuously, whether people will buy it. So many questions to be answered. I don't think it is very easy, and none of us understand valuation of companies like Paytm and Zomato. In 2040, we may be saying, wow, we missed this, or we would have said, oh God, there was this company and now it's gone under. Right? So we don't know what we are going to say. I remember the rush there was to buy Reliance Power in the IPO at 450 rupees. Now I don't think it's a great buy even at 4 rupees 50 paise. So these things happen in the market. You have to be ready for it. And unless you are very alert and you're paying attention and you're not just getting carried away by labels and marquee names, you have to be careful. It is not simple to make money by just buying the best shares. If you just want to do that, you might as well do indexing, because you are buying the market at a higher price or a lower price, but you're buying the same quantity at least every month. Right? So I think it makes sense to do that. But then the lure of buying shares and making money and talking about it in parties will never go away. So people will continue to do it. I love what Sam Manekshaw said, that 4-day war requires a 361-day preparation. Exactly like that. To buy a share takes 1 minute. How much time does it take? Call your broker and buy it. Go online, buy it. It doesn't take you more than a minute. But to know what to buy, what quantity to buy, how much to hold, how long to hold, when to sell, that is what requires your brain power. So I'm saying build up a portfolio of 30-40 stocks over the rest of your life. So if you're 25 till the age of 55, you're building a stock. I'm talking of buying just one share every year. Maybe you will buy 2 or 3 and sell off 1 or 2 which are not doing well, but that is all you need. But if you are trying to buy one share every day, then it's a problem.
Okay. How important, Subra, is having an expectation of returns? Because I'm taking from the point you made in terms of indexation. You buy an index and you have an estimation that, okay, if India's GDP is going to grow at such and such, plus X percent is going to be the growth in this index, is the assumption that you make. 10, 11, 12% is something that you can think a benchmark index could give you over the long period of time, CAGR. But if you're picking and choosing stocks, you should ideally be beating that index, right? So how do you make that assumption in terms of what your return should be?
It's very difficult. Alex, I can speak on both sides. I can say don't be passionate about what you're doing and you will build a good portfolio. But it is impossible not to be passionate about. See, if I paid 1,000 rupees for a share in 1977 and I'm getting 1.5 lakh rupees dividend from that, it requires 16 horses to pull me away from that share and say the future is bad, sell it off. It's really very difficult. So you will be passionate, you will build. So my logic is very simple. At 22, if you don't know how to do it, great. Put money in the index and keep buying one share and see how that share is performing, and then slowly build your portfolio. If your own portfolio is outperforming the index, great. If the index is outperforming your portfolio, then accept the fact that you're not a good fund manager. Most important thing, write down in a diary why you're buying, what you're buying, how long you will keep, and keep updating that page as to what has happened every 3 months, 6 months. See, something has happened, the MD has died, MD has left, the promoter has changed, something like that. Keep updating. And one day you will decide to keep the share or not keep the share or things like that. But at least you will have a learning of what you did, and you will have it written down by hand. Don't maintain this in a Word document so that you can't go back and delete, because you should write down what you're feeling today so that 6 months later you can feel, oh God, how stupid was I? Or say, how smart was I? Right? So writing down all that makes sense. Slowly build your portfolio.
One of the favorite sayings that I have and that has held me in good stead is that the wisdom of retrospect is flawless. And when it is written in black and white, there's no hiding from that truth. Mr. P.V. Subramanian, thank you so much for taking the time. It's been a very insightful conversation. As always, a pleasure.
Thank you.
All right, on that note, we are at the end of this edition of The Money Show. It's been a pleasure bringing it to you. Do stay tuned. Lots more coming up over the course of this evening. This is ET Now.